As per an industry report, India's lubricant market is expected to grow 3% annually in terms of volume over the next few years. From rugged trucks to state-of-the-art F1 cars, this company has more than 120 years of heritage.
Let's deep dive into what an investor must look at while analyzing this company.
So Gulf has a long history. It's over 120 years ago that Gulf started in 1901 in the Gulf of Mexico. And this history dates back to that year where this brand really flourished. It started with a motor oil which was the best in the world, Gulf Pride, and Chevron acquired the brand. After that, of course, it won many races in motorsports in its blue and orange colors, which have now become legendary. The Hindujas looked at this brand in the mid-80s and wanted to have a brand which had a global appeal, a global consumer brand, and acquired it through various initiatives. And the brand rights for this was acquired by a Hinduja group company called Gulf Oil International, which owns the brand now for entire world except USA, Spain and Portugal. So really the brand now with the Hinduja group has taken strides ahead. It's present in more than 100 countries, not only automotive, industrial lubricants, we are there in marine lubricants, and it has grown. We're very proud that in India, this brand is now one of the leading brands, and we could look at the history in India, which is also decades long. And today we're very proud that we are the second biggest brand in terms of the industry, in terms of our consumer feedback, our recall, and in terms of the private sector, we have the second highest volume in the country today.
Despite increasing electric vehicle sales which use fewer lubricants, India's lubricant market is still expected to grow.
Gulf Oil is India's number 2 lubricant brand. The company generates 95% of its revenues from India, serving both B2C and B2B markets. Gulf Oil has a diverse portfolio. The B2C segment contributes to 60 to 65% of Gulf Oil's income, offering stable, recurring revenue. Its broad, expanding dealer network and strong brand help the company grow this segment. The B2B segment makes up 35 to 40% of sales, is cyclical but experiences strong growth during upcycles. As an investor, it is critical to understand the share of revenues coming from stable business segments because they help the company to weather tough times. At the same time, timing the entry into the stock right before the upcycle can deliver above average returns. Of course, it does involve some understanding of the industry. Gulf Oil has a nationwide network with 80,000 plus touchpoints, 300 plus auto distributors, 70 plus industrial distributors, and 500 plus B2B customers. Between FY19 and FY23, its revenue grew swiftly at 15% CAGR. In the recent past, rising input costs have squeezed Gulf Oil's EBITDA margins to lower double digits. Its margins usually move inversely to crude oil prices. However, the company expects margins of 12 to 14% supported by a superior product mix. Product mix refers to total variety of products that the company offers to its customers. A diversified product mix may be considered better by an investor. Similarly, a diversified customer mix is preferred and reduces concentration risk. In the last few years, Gulf Oil has gradually diversified into business segments which are unconventional, yet they leverage into its existing distribution channels, customer relationships, and brand image. Currently, these products and investments make a minimal contribution to the overall business. However, to a long-term investor, they do indicate the management's agility to rapidly adapt to the structural changes in the market. Investors often evaluate a company's financial health by analyzing various return ratios. Two critical ratios among many are return on equity, which measures the amount of profit generated as a percentage of owned funds, and return on capital employed. It helps investors to understand how well a company is generating profits from its owned and owed capital. For manufacturing companies like Gulf Oil, assessing leverage through the debt-equity ratio is crucial. A higher debt level such as a 2:1 debt-to-equity ratio can strain profits in tough times and risk leading to a debt trap. To know more about Gulf Oil, visit Upstox app or Upstox stock detail pages. This is Milan Bhaveshi signing off, and I'll see you in the next video.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.